Everyone. Hi, Jason. Hi, Karsten. Hi, everyone. Okay, as usual, you guys need to give me like a minute to just check that the Vantage app is also working. Christ or Chris. Okay, hi. Okay, so I'm just gonna start today's webinar and I'll let Vantage figure out the back end stuff. Okay, anyways, hi, everyone. Hello, hello. Hi, Patel. Welcome to today's webinar brought to you by Vantage. We're going to do Tech Wars, AI chips and market competition today. It's going to be, I think, an informational webinar. A lot of information, a lot of like seeing things from a different point of view. It's just good information to have. Right? Do I recommend you jumping straight to go and trade all the tech and AI stuff? Well, you can if you want to, but sit through the webinar and then find out if it's something you want to be trading. Okay, so yeah, before I start, you guys know how this works. I do have to do the disclaimer. Basically, the disclaimer is just a reminder to remind you guys that this webinar is purely for educational purposes. Nothing in this webinar should be construed as investment or trading advice. It shouldn't be any form of signal to buy or sell. So please do your due diligence before trading, all right? Like another risk warning, trading Forex and CFDs, especially if you are trading on margin, does carry it does carry significant risk and is not suitable for all investors. So please be cautious. Even for me, I've been trading for almost 10 years now. And I mean, next year will be my 10th year trading. I still have losses and it's normal. Losses are normal. So please don't like throw all your eggs in one basket. Don't like, yeah, just be cautious, okay? It is a dangerous game. Do not jump into the ocean without learning how to swim. So I'm gonna stay here for a minute or two while I reply Vantage. You guys read through the disclaimer and then we can start today's topic. Yeah. I don't think Vantage can work on the Vantage app today, but it's okay. Okay, cool. That should be like a minute or two already, and you guys should have that should have been enough time for you guys to read this disclaimer. It is important that you read through this disclaimer. It is I legally have to show you guys the disclaimer, and you guys need to understand that this is purely educational. Okay, so let's start by introducing myself. For those who don't already know me, my name is Cassandra. You guys can call me Cass. I am an investment analyst and also a prop trader. So I'm an investment analyst from Everest Fortune Group. We are a company from Singapore. Okay, you know, the tiny island in Asia, strongest passport in the world. Yeah, so we are a company in Singapore and we basically do a lot of research on the markets and basically anything to do with finance, like investment-wise, finance, investment. So we do a lot of forecasting, a lot of research, a lot of back testing, a lot of like, we come up with a lot of papers and a lot of ideas on where we think the markets are going, and we advise banks, financial institutions, brokers, you guys, okay, on where we think the markets are going. So we are very versed in the markets. On top of that, I am a prop trader. For those who don't know what prop trading means, it means that I trade companies' funds. Okay, I've been funded by multiple companies. How did I get funded? I had to pass a few tests. The test that a lot of people find very hard is to do 10% profit within 1 month. So 1 month, you have to deduct the weekdays, right? So, sorry, the weekends. So you've only got the weekdays, so it's 22 trading days, and because the weekends are not counted, so you need to do 10% profit within 22 trading days. That's actually a very normal number for me. I easily do 10% profit within a month, and I do that using technical analysis. I ended last month with about 8%. Okay, so I did the first week of last month, I didn't trade at all because I was sick. The second week, I did 3%. The third week, I did 2.5%. And the fourth week, I did about 2.5% to 3%. I think it was about 3%. Yeah, I did about 3%. So last week I ended about 8%-ish. And yeah, that's why I'm here to share my experiences and to help you guys become better in trading. So if you guys have any questions, please don't be shy. The whole point of Vantage bringing these webinars to you guys is so that you have a place to ask questions, to interact with a professional trader, and to, help you with any challenges that you are facing. So even if your question is not related to today's topic, you can still ask. I'll try my best to answer it. You don't have to worry about delaying the webinar, because I'm very sure I can finish today's topic within an hour, because today's topic is very informational, right? So I'm sure I can finish it in an hour. Okay, our agenda for today will be to look at the US-China rivalry over semiconductors and AI. Okay, the winners, which are, well, the chip makers, the cloud, and cybersecurity. The losers, which are companies exposed to supply chain bottlenecks. And we can then look at trading NASDAQ and individual tech stocks during policy shifts. Okay, sorry, just one more time to check in with Vantage to see that that they've got my message. Okay, just one quick minute to let them know. Yep, it's not on the Vantage webinar. I've been told to just proceed. Okay, let's move on. Give me a moment, guys. I need to adjust some things. Okay, there you go. Can you guys see my screen? Yes. Sorry, it wasn't moving a while ago. Okay, cool. So, okay, all right, everyone. Let's start with the big picture, the US-China tech rivalry. This is not just about trade anymore. We're talking about a new Cold War that keeps happening every time Trump becomes president. Okay, but instead of nuclear weapons, it's powered by chips and algorithms, which is actually better, okay, because we do not want nuclear weapons. We don't mind this war as long as it's not nuclear. Okay, so you see semiconductors, those tiny chips that power everything from your phone to missiles to AI, everything tech, well, not everything, anything you can think of that is tech would require a tiny chip. Okay, they are now the most strategic resource on the planet. Whoever controls the chip supply chain controls innovation, defense, and even finance. So let's rewind a little. Around 1980s to 2000s, the US dominated the tech space with Intel, Microsoft, IBM, and, well, basically all American. Then around 2010, China started catching up. So we've got Huawei, Tencent, Alibaba, and most importantly, the massive investments in AI and chip manufacturing. Okay, so the US saw this and said, wait, hold on. If China builds the chips, runs the data centers, and dominates AI, we will lose our edge. Okay, So what happened? In 2019, the US started restricting chip exports to China. They blocked companies like Nvidia and AMD from selling advanced GPUs and power artificial intelligence models. And remember, AI models like ChatGPT, image recognition, or self-driving algorithm, all those require chips. Okay, every time you use ChatGPT, a chip is being used. Okay, so then came the Chip and Science Act, a huge US government program giving billions of dollars to bring chip production back home. They want to reduce dependency on Taiwan and South Korea because those countries are right next to China. And from the Chinese side, they're not just sitting quietly. China has poured billions into local chip makers like SMIC and YMTC. They are developing their own version of AI chips to avoid US sanctions. And interestingly, even with restrictions, they've managed to produce advanced chips that analysts didn't think possible this soon. So what does this mean for the markets? Every headline, US bans chips exports. China announces AI investment funds. Taiwan semiconductor opens US plant. Okay, they are not just tech stories, they're market moving catalysts. Whenever the US tightens restrictions, US chip stocks can rally short term because of protection, but long term, it could hurt their sales in China, a major consumer base. From a trading perspective, this is gold. Okay, so when there's a new export ban, traders often look at Nvidia, AMD, or ASML for volatility spikes. On the flip side, Chinese tech ADRs like Baidu or Alibaba can drop instantly. Okay, so think of this rivalry like a tug of war. The US wants to protect intellectual property and maintain control. China wants independence from Western tech. And the battlefield, it's the global semiconductor and AI market. So this rivalry affects everything, okay, from chip prices to Nasdaq volatility to even currencies like the Taiwan dollar and Japanese yen, which are tied to semiconductor exports. So before we talk about winners and losers, the key takeaway is this: the tech war is not temporary, it's structural, it's long-term, it's shaping every sector, not just tech, but global finance, manufacturing, and even defense. Okay, so let's now zoom in on semiconductor supply chain. Because once you understand how chips move, you understand how the money moves. Okay, so here's the funny thing. The US dominates the design side. Companies like Nvidia, Qualcomm, and Intel, but most manufacturing happens in Taiwan, South Korea, and parts of Japan. So when I say Taiwan, I mean TSMC, which is a company, and for South Korea, it is Samsung. Okay, you know, like Samsung, the phone. Okay, meanwhile, China assembles, tests, and integrates these chips into devices. So imagine a chip designed in California, printed in Taiwan, tested in Shanghai, and installed into a smartphone sold in Europe. That's how interconnected the industry is. Now, when politics steps in, for example, if the US bans certain exports to China, that entire chain gets disrupted. Prices go up, supply gets squeezed, and that trickle down of every tech sector from EVs to gaming PCs. This is why you'll notice whenever there's tension between the US and China, maybe a spy balloon incident, maybe a sanction, the Nasdaq reacts instantly. because investors start pricing in potential supply bottlenecks. Okay, so for traders, you don't watch Nvidia's chart, you watch policy headlines, Taiwan risk, and AI spending trends. The moment something big happens, you see it reflected first in chips stocks, then in the border tech indices. Okay. Okay, so how do we trade around this, especially if you are using a platform like Vantage? The first thing is don't just follow earnings, follow policy headlines. If the US announces new chip exports restrictions, expect conductor stocks to react within hours. You can look for opportunities in NASDAQ, CFDs, or trade individual names like NVIDIA, AMD, or ASML if available. Secondly, pay attention to rotation. When tech gets hit because of policy, money usually flows into defensive sectors. Utilities, healthcare, or even the US dollar, that's where you can hedge or find alternate setups. And lastly, remember this. AI isn't slowing down, even if China and the US fight over who gets the chip. Demand of computer power keeps exploding. That means the overall directional trend of the tech industry long term still points upwards. The volatility in between, that's where traders like you and me find opportunities. Okay? So this market isn't going anywhere. Okay, so let's move on to our second topic for today, which is the winners, chip makers, and cloud and cybersecurity. Okay, so let's get into the fun part, the winners. You know, when people hear tech war, right? Hi, for those who just joined, just give me a moment. I was waiting on Vantage app. Okay, yeah, hi. So I'm not sure what happened, but there was a technical problem and the webinar was not streaming on Vantage app. So I'm glad you found your way to Zoom. Okay, we usually stream this on both Zoom and Vantage app. So I'm glad that you managed to make your way here. Okay, so you didn't miss much. We're just talking about like the first part was just the China and US tech wars. Okay, but other than that, we're just in the second part. Okay, so let's get into the fun part, the winners. Okay, you know when people hear tech war, they think of restrictions, bans, and problems. But let me tell you, for some companies, this is the best thing that's ever happened to them. I don't know why. Okay, this is one thing I want to clarify. Whenever people say the market is down or people are losing their jobs or people are losing money or the economy is not doing well, I just want you guys to remember, if today, I'll just give a rough number. If today there's $100 circulating in the world, okay? I know there's way more than that, okay? Let's say there's $100 circulating. Okay, there's like 20 plus of you here today, almost 30 of you here today. So let's say there is $100 circulating amongst us, right? If one of you and each of us gets $3, right? All of us gets $3 and then it comes up to $100 in total. Let's say today you lose $3. That means in our circle, someone is going to gain $3. Okay, that's why whenever you guys think of the markets, you need to know that the market is a zero-sum game. If someone is losing money, it means that someone is gaining money. That's all it is. It's just a transfer of wealth. There's never like oh, the economy is doing so bad, people are losing their jobs, they're losing their houses, they're losing blah blah blah, whatever it is, right? Hi, Jamilu. Oh my gosh, hi, Jamilu. Nice seeing you. Fancy seeing you here. You are everywhere, right? Okay. Yeah, so let's say someone loses money in the market, someone is going to gain that money. That's why in every setting, in every economic condition, everywhere, no matter if it's a bad economy, a good economy, something, someone is making money and someone is losing money. So we just need to know where the money is moving to. It's never that everyone is losing money. It is always a transfer of wealth. It is always a transfer of wealth. Just because someone is losing money, the money doesn't disappear into thin air. If you lose money, it means the money is going into someone's pocket. We just need to know where the money is going to. That's why in every condition, you need to know who are the winners and who are the losers. Because when you know who the winners are and who the losers are, then you will know where to put your money in. Okay? Okay, so let's start with the very obvious one. In any tech war, the one that is going to be a winner for sure is going to be the chip makers. Okay, when the world realized that semiconductors were the new oil, companies like NVIDIA, AMD, TSMC, and ASML went from being just tech names to becoming the backbone of global economy. NVIDIA, for instance, 5 years ago was known mainly for gaming GPUs. Fast forward to now, they're the heart of AI revolution. Every AI model, whether it's OpenAI, ChatGPT, Tesla's self-driving system, or healthcare imaging, it relies on NVIDIA's H100 chips. These chips are so powerful and scarce that major corporations are literally fighting to buy them. Okay, they are even waitlist. Imagine a waitlist for semiconductors. That's how dominant NVIDIA has become. And what caused this? Ironically, the US-China tension boosted demand for these chips. The US restricted China's access, so everyone else rushed to stockpile. Companies and governments are hoarding chips the way countries used to hoard oil. Okay, now let's move on to cloud companies. The second group of winners, okay, if chips are the hardware, sorry, my screen stuck. Okay, if chips are the hardware, cloud computing is the infrastructure layer that makes AI usable. Think of Amazon Web Services, okay, Microsoft Azure, and Google Cloud. When AI models run, when you use ChatGPT, image generators, or voice recognition, that data isn't processed on your device. It's processed in a massive cloud data center powered by thousands and thousands of chips and cooled by industrial-grade systems. I don't know if you guys saw this, and I also don't know if it is real. I didn't actually go and research on it, but I saw something on social media where they said that China has started to cool their chips in the ocean. So they just put a whole like tanker in the ocean and just let the sea floor cool it. Okay, but I don't know if it's true. But yeah. So every time companies expand their AI capabilities, they're actually renting more servers, buying more cloud capacity, and burning through electricity and chips. That means higher demand for cloud providers. Now, let's not forget the cybersecurity sector. You can't have advanced AI and data centers without data protection. When geopolitical tension rise, cyber attacks skyrocket. State-sponsored hacking is now part of modern warfare. I mean, I guess it's better than people dying, right? At least they are not bloodshed. At least it's now everything is cyber attacks. So we've actually seen cyber attacks on pipelines, hospitals, even stock exchanges. And that's why companies like Palo Alto Network and CrowdStrike and Fortinet are booming. Here's the thing, cybersecurity used to be niche, now it's a necessity. Governments, corporations, even small firms need protection. Every time the US or China makes a move, cybersecurity budgets go up because data is power. And in this era, whoever protects the data protects the business. So if you think about it, these winners are all fed off each other. The chip makers build the hardware, the cloud companies provide the infrastructure, and the cybersecurity firms protect the ecosystem. They form a triangle, each one supporting the other. And guess what? The triangle sits right at the center of the biggest capital rotation in modern history, from traditional manufacturing into digital infrastructure. So when traders say AI bubble, maybe it's not a bubble, maybe it's a structural shift, because these three industries are not just selling software and gadgets, they are selling the foundation of digital economy. Okay, so I have put a picture here of the size of what the chip markets could look like. Okay, it is going to be huge. This is in billions, if not, will end up in trillions. Okay, so now let's put the numbers to the story, because numbers don't lie. In 2020, the AI chip market was valued at roughly 10 billion. Today, we're looking at 60 plus billion and forecast to hit around 300, sorry, to about 300 plus billion by 2030. That's a 20 times jump in a decade. Okay? Sorry, that's like 10 times jump in a decade. Okay, so Nvidia alone gained so much market cap that briefly joined the trillion-dollar club, which used to be exclusive to Apple, Microsoft, and Saudi Aramco. Okay, so cybersecurity, the global cybersecurity market is growing at around 12 to 15% per year. But here's the interesting part. Government spending on cyber defense has exploded since the Ukraine war and increasing tensions in the South China Sea. This isn't just commercial, it is national security. And for cloud, the numbers are mind-blowing. Amazon AWS generated over 90 billion in revenue in 2024. Microsoft Azure around 80 billion, and Google Cloud about 45 billion. And most of that growth is coming from AI model hosting, data processing, and storage. So while the market debates inflation or interesting rates, tech infrastructures quietly keeps compounding. That's why in almost every correction, the smart money rotates back into chip makers, cloud, and cyber, because these are not tech stocks anymore. They're modern utilities. Okay, so as a trader, how do we position ourselves in this? Okay, so with Vantage or whatever, so with Vantage, you don't need to buy the actual stock, obviously. You can trade CFDs on the NASDAQ or individual chip and tech names. You can look for momentum trades after AI and chip earnings like NVIDIA and AMD, news-based volatility. When governments announce new policies or subsidies, pull back entries during short-term sell-offs, because these industries tend to recover fast. So one tip is to use a sector watch list. Keep chip makers, cloud, and cybersecurity names side by side. You'll start noticing correlations. When NVIDIA spikes, cloud often follow. When cyber breach hits the news, CrowdStrike or Palo Alto might gap up. And here's the best part. The story isn't going away. Even if interest rates stay high and global demand slow, governments can't stop investing in these sectors. They're too strategic. So the next time you hear tech war, don't think of just tension, think of opportunity. It's not just tech wars. I think I mentioned this a lot in a lot of my webinars. Every time there is a crisis, as an investor, it means that there is opportunity. Okay? Every time there's a crisis, there's opportunities for investors. So I know it's very bad to say, but sometimes I know the economy is not doing well and then you see the markets dropping. That's when me as an investor, and I know so many other investors, they get excited because that's the time when the markets are moving a lot. Okay, so because for smart traders, geopolitical disruption often equals volatility, and volatility equals potential profits. Okay, so would you guys want to ask any questions so far? If not, I'm going to continue. Yeah, I'm gonna finish really quick with today's webinar, because again, today's webinar is a lot of information based. It's just very info based. So I will be done with giving you guys the information in about 10 to 20 more minutes, and then you guys can ask me questions if you guys have any. All right, I'm gonna stay on this slide for a while because I do have a lot to talk about when it comes to the winners and the losers and who actually benefits and who gets crushed. Okay, so now let's understand what's fueling this tech war. AI dominance, okay? Can you guys let me know in the chat box who uses ChatGPT? Okay, thank you. Yeah, I think a lot of people here use ChatGPT. I use DeepSeek. Okay, that's the Chinese company. Yeah, so I would say a lot of you here do use ChatGPT, or if not some form of AI, sometimes Gemini, okay, some kind of, yeah, because it is useful. If you don't, like, I cannot survive without ChatGPT. Do you know when I'm doing a lot of my research, I'm using a lot of ChatGPT to do my research and prepare these slides for you and all the information, because if you use Google, it takes too long to collect information, right? Like with ChatGPT, especially if you are paying for like the paid version, which I have the paid version, I can go so in depth into a topic and like understand a topic so thoroughly. That's why I always tell people it is 2025, right? We have AI on our fingertips. If you are not making money in 2025 with AI, there is something wrong with you guys. Okay, with AI, there's so many opportunities to make money. Okay, because AI can help you do the research and help you collect the information and the data. So I do recommend you guys using it if you're not already. Okay, so anyways, let's go back to what is fueling the tech war. AI dominance, semiconductor control, and strategic decoupling. Let's talk about the juicy part, who's winning and who's actually losing in the global power play. Because as traders, we're not here to pick sides politically. We're here to identify where the money's flowing and who's bleeding out, because we want to go to where the money is flowing. So let's talk about the winners, the golden trifecta. Okay, there are three main groups of winners in the AI. Semiconductors, arm race. If you're trading tech or indices like Nasdaq through Vantage, these are the sectors you want on your radar. Okay, so number one will be the chip makers, the heart of global digital economy. These are the companies sitting right in the middle of the US-China rivalry. Think of NVIDIA, AMD, TSMC, ASML, and even Intel and Facebook, Amazon, okay, AMD. Oh yeah, I already said that, sorry, and Microsoft, okay, which is making a comeback thanks to government subsidies. Here's the deal, chips aren't just chips anymore. They're the new oil of the digital age. Every AI model, every data center, every autonomous vehicle, they all run on advanced semiconductors. So when the US restrict chip exports to China, what happens? Okay, two things. Demand spikes for alternative suppliers. Prices for high-end chips go through the roof. That's why companies like NVIDIA have seen mind-blowing rallies, not just because of AI hype, but because they've become indispensable to both Western and Eastern tech ecosystem. But traders should note this sector is volatile as hell. One new sanctions one government policy change and chip stocks can drop 10% overnight. So if you're trading NASDAQ or chip-heavy ETFs, always keep an eye on policy headlines. Okay, so the second one will be cloud and AI infrastructures. Then you've got the second winning group. Okay, companies like Microsoft, Amazon, Google, and Oracle are building massive AI cloud ecosystems. Every company that wants to use AI, from startups to governments, need cloud capacity, and that's where these giants make a killing. So when you hear about AI adoption or machine learning expansion, don't just think of flashy new apps. Think of plumbing, the servers, data centers, and cloud bandwidth behind it all. So here's where traders get an edge. When chip prices rise, cloud companies usually absorb some of the cost, but if AI demand keeps growing, they can pass the cost down to users, maintaining their margins. That's why you'll often see cloud stocks dip temporarily during chip shortages, then rebound sharply when the AI cycle strengthens again. So the third will be cybersecurity, which will actually be the silent winner. Now, this one often gets overlooked, but as AI adoption grows and global tech competition intensifies, cyber threats are exploding. Governments are pouring billions, billions into cybersecurity, and corporations are realizing that one ransomware attack can literally wipe out their reputation overnight. So companies like Palo Alto Network, CrowdStrike, and Fortinet are striving. These names are not just flashy headlines like Nvidia or Tesla, but they are quietly sitting in the perfect position, long-term, high margin, and increasingly indispensable. If you're looking for slightly less volatile exposure to tech arms race, cybersecurity stocks can offer that middle ground, especially when broader markets get shaky. Okay, so who are the losers? Okay, the losers are companies reliant on China supply chain. This one is brutal. Okay, if your product depends heavily on Chinese manufacturing or rare earth materials, you're on the chopping block. Think of consumer electronics companies like Apple, which, despite being a US darling, still assembles most of its products in China. So every time tension flares up, company stocks wobbles. It's not that they're going bankrupt, it's that their risk exposure is massive. Traders should treat such names as sensitive plays, great for short-term volatility, but risky for long holds if the US-China relationships keeps deteriorating. Okay, so the second one will be the small cap tech companies and startups. We've got the smaller tech players, especially those without direct access to chip supply or cloud infrastructure. These companies get squeezed the hardest. They face high chip costs, higher borrowing costs, thanks to Fed policies, and slower time to market for their AI product. A lot of them can't even compete with the big guys who are hoarding chips and buying server capacity in bulk. So unless they're sitting on a niche innovation or IP, they will struggle. That's why in the tech war, big tech gets bigger and the small tech gets squeezed out. So the next will be the emerging market manufacturers. Okay, they are the quiet casualties, emerging market exporters. Countries like Malaysia, Vietnam, Indonesia have been benefiting from the AI plus one supply chain strategy, but they're also at risk. Why? Because when tech demand slows down, or when the US and China impose export bans, orders get cut overnight. So if you're trading currencies, commodities, or indices in emerging Asia, watch for semiconductor cycle slowdowns. They tend to lead equity downturns by a few months. So here's the key mindset shift. In this era of tech war, fundamentals alone won't save you, okay? Policy is the new price driver. You can have perfect earnings, but if a new export restriction drops, your stock tanks. That's why it's so important to trade with a macro view, something we emphasize when trading NASDAQ and US tech stocks via Vantage, for example. So things that you can watch out for are Washington's policy headlines, Beijing's countermeasures, supply chains reports from Taiwan and Korea, and quarterly chip data. Those are your real-time indicators of tech market health. Okay, so I'm gonna go into our last part, which is trading Nasdaq and individual tech stocks during policy shifts. Yeah. Okay, let's bring this one home. Let's understand how to trade Nasdaq and individual tech stocks during policy shifts. Okay, we've talked about the US-China tech war, who's winning, who's losing, and now the real question is, how do you trade the chaos profitably? Because all this knowledge means nothing if you can't turn it into strategy, right? Knowledge means nothing, absolutely nothing, if you cannot make use of that knowledge, right? Knowledge is only power if you use it. Okay, so how do you use it? You know AI and tech is going up. How do you use it? Okay, so first of all, let's be clear about what you're trading. The Nasdaq, okay, the Nasdaq isn't just a tech index, it's practically a sentiment barometer for global innovation. When investors are optimistic about AI, chips, and digital economy, Nasdaq will fly. When fear creeps in, policy tightening, export bans, or chip shortages, it bleeds fast. So as a trader, think of Nasdaq as a global tech mood tracker. It reacts not just to earnings, but also to politics, Fed, politics, policies, and even social media hype. So here's the truth. In this era, policy headlines move markets faster than earning reports. Let's say Washington announces a new export restriction on advanced chips to China. Instantly, you'll see NVIDIA, AMD, TSMC stumble within minutes. Cybersecurity and AI software stocks sometimes rise as capital rotates into policy-safe tech. Nasdaq futures react before most traders even finish their coffee. The trick is treat policy like data releases, the same you would with NFP and CPI. Before major political summits, G7 meetings, and government announcements, tighten your stops, scale down, leverage, and stay alert for fakeouts. It's not about predicting the news, it's about being prepared to react fast when it hits. Okay, so here's a simple way to organize your watch list. Start with policy-proof stocks. These companies are less affected by global geopolitical headlines. Think Microsoft, Amazon, CrowdStrike, Palo Alto Networks. These software, cloud, and cybersecurity services that are globally scalable and less reliant in China or rare earth supplies. These are your core holes where the world looks messy. I think if you are looking for like long-term investments, you really can look at these companies like Microsoft, Amazon, CrowdStrike, Palo Alto. Okay, so these policy-sensitive stocks like semiconductor manufacturers like NVIDIA, AMD, TSMC, and hardware makers like Apple, Dell, HP, basically anything exposed to manufacturing and export bans. These names can give you huge profits, but only if you're on the right side of the policy cycle. When relations stall and chips demand surges go long, when sanctions rise or export controls tighten, consider shorting or stepping aside. The simple classification helps you stay emotionally stable during market chaos. You'll know why sometimes something is moving instead of panicking when what is moving. Okay, so then you also want to use Nasdaq for direction, stocks, and precision. Think of Nasdaq as a compass and individual tech stocks as your sniper rifle. When Nasdaq breaks structure, for example, strong higher highs or volume, that's your macro confirmation that risk appetite is back. Then you zoom and pick the strongest names leading the rally, usually NVIDIA, Microsoft, or Meta. But if Nasdaq starts showing weakness, lower highs, failed breakouts, rejection near the key fib levels, you don't fight it. Instead, shift to defensive plays or stay flat until the index stabilizes. This is especially important through when you are trading through Vantage, because you can use both CFDs and indices, allowing you to hedge positions or scale in based on volatility. Okay, so the fifth is to pay attention to global liquidity. AI hype can pump prices, but without liquidity, those rallies die fast. So always keep an eye on the Fed's rates decision. The US dollar, which you can look at DXY, a stronger dollar often pressures tech valuation and even bond yields. Rising yields usually weigh on growth stocks. When the Fed signals rate cuts or easing, that's a green light for risk on moves in Nasdaq. When they talk about tightening or higher for longer, that's your cue to tighten stocks because the air gets thin for tech valuation. So the sixth will be to combine fundamentals and technical analysis together. It's the same for anything. As long as you're trading, you should be combining both fundamentals and technical analysis to get more accurate analysis. Okay, the seven is to build a plan. You can ask yourself, what will I do if the US bans another AI chip export? What's my plan if China retaliates? Which stocks benefits from each outcome? That's how pros trade, with pre-planned contingencies. Do you have a plan that you can share with us? Okay, thank you for asking. I don't have a plan that I can share with you guys for AI because I don't currently anticipate to trade AI. I still am very heavy on Forex. Okay, but if this is something that you plan to trade, if AI is something you plan to look into and go deeper into, you can come up with a playbook, a policy playbook. Okay, and that is to follow to ask yourself what to do if a retaliation happens, if China and US have another tech war, if, whatever it is. Okay, so the big picture is the tech war isn't ending. Let's be honest, this US-China tech rivalry isn't cooling off anytime soon. It's not a 2025 story. It's a decade-long structural shift. Every few months, we'll see news bans, new subsidies, and new alliances form. But for traders, that means endless opportunities. Volatility is our playground. The goal isn't to predict who wins the tech war. The goal is to ride the waves, each policy shift with discipline, risk control, and sharp timing. Okay, so that's all I have for you guys today, actually. So let's wrap this up. If there's one big takeaway for today, the first one is that the tech war isn't just about gadgets or chips, it's a global power. It's about global power. It's literally watching history unfold in real time, governments shaping markets, supply chains redrawn, and investors caught between politics and profits. AI chips, thank you, Jamilu. AI chips and data, these are the new oil of the 21st century. Whoever controls them controls the future. And for US traders, this constant tension, it's both a risk and an opportunity. Okay, so do take note on AI. Do keep in track so that, whether you're trading tech stocks, NASDAQ, CFDs, or AI-related plays, remember to stay data-driven. Okay, data is so important. Watch policy like you watch prices, trade reactions, and not emotion. Because this tech rivalry, it's not going to go away, okay? It's the new normal, and if you learn to navigate it, you learn to run out of trade. You will never run out of trading opportunity. Okay, so if I have like about 10 more minutes with you guys, well, 5 more minutes, 5 to 10 more minutes with you guys. If you guys have any questions, you guys can shoot me in the chat box right now. Okay, so should we trade NASDAQ all the time since tech is the future? Should we buy and hold NASDAQ? Okay, a very good question. Not necessarily. NASDAQ gives you great volatility. Okay, but you need timing. When Fed policy is tightening or geopolitical risk is high, it's okay to step back or switch to defensive plays. Okay, don't marry a sector. Yeah, don't marry a sector. Just date it when the conditions are right. So you don't have to trade Nasdaq all the time. It's still the same. The markets will still move in a zigzag pattern. Am I able to get this recording? I was late. Yes, you can just email Vantage and they will just send you the recording, the link to this recording. No worries. Okay, so I've got another question here. If AI and chips are the new oil, does that mean we're still early in the game? Okay, that is a very good question. Yes, 100%. You guys know whatever information I just told you. Maybe it's your first time hearing it, maybe it's you've heard it many times. But if you've heard it today, it means that you are earlier than a lot of people. I can assure you right now, a lot of people don't even understand AI. They don't understand chips. They don't understand semiconductors. Okay, so we are 100%, we are still early. AI adoption, semiconductor expansion, automation, all of this is still in its growth phase. We haven't even seen the full monetization yet. That's why short-term pullbacks often become long-term buying zones. I don't know if you guys were the group of people that I shared this with. Sorry, I've got a message here. Would you recommend investing in Nasdaq ETF to ride the AI momentum, but also minimize risk by individual stocks? Okay, I'm gonna share what I personally do. Okay, what I won't recommend it to people, but if you guys think this is something you guys want to follow suit, you can. But this is what I personally do. I personally do buy individual stocks and hold it for long. So if you guys were the group of people that I shared this with, I actually bought Tesla at $300 in July. Um, Let me just check. I am on the track. Tesla today is at $468. In July, right? In July, it was it went as low as $284. I got in at $300. So I've made about 50% of my Tesla stocks. Okay, why did I do that? Because if you actually follow AI very closely, you know that there's so much growth in it, and it is not an industry or it is not a field, it is not a sector that is going to die anytime soon. Therefore, I did put money in it in July because I had spare cash lying around, but I won't say to go all in. Definitely don't go all in because your portfolio should be diversified. For my case, I share this a lot with you guys. My portfolio, I think a very small section of it, about 10% of it, I put into trading. The rest of my portfolio, 90% of my portfolio is actually in long-term investments. Okay, so like ETFs, Forex, it's only 10% of my portfolio, whereas the rest of my portfolio, a big bulk of my portfolio is actually in long-term investment. So I do property, buying individual and holding stocks, buying cryptocurrency and holding cryptocurrency. You should not put all your eggs in one basket. You definitely should not put everything into trading and trying to get rich out of trading alone because that's not going to work. You should definitely have some in long-term investments. And a lot of my portfolio is also in business and also in dividends. Yeah, I have it in dividends, okay, and bonds as well. Okay, so it's very slow, it's very safe, but it is something that if I lose my entire Forex account, if I lose all my money in Forex, at least I still have the rest to back me up. So never, ever, 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 I beg you guys, never, ever go all in into one thing. Okay? When do I start an AI system? I don't plan to start an AI system because I don't know much about it and I'm not an expert in it. Okay, I am confused. If China's producing more chips right now, why do US stocks still lead? Okay, that is a good question. It's because innovation ecosystems matter more than production. Okay, China is just the factory. Okay, but the idea behind it is still US. The US still leads in software. They still lead in AI research, cloud manufacturing, infrastructures, and venture capital. Okay, that's why America or US tech remains dominant even if the manufacturing shifts elsewhere. But if China figures out the brains behind it, then yeah, US will definitely lose, right? Okay, so if you guys have any more questions, uh, I'll just answer one more question on the webinar because we are done for today. Okay. Um, does that mean I can short Nasdaq when policy tension rise? Okay, yes, you can short Nasdaq if you are someone who follows the news closely and you are following these policies closely. Again, yes, especially if you see technical weakness aligning with negative headlines, but always manage risk. Okay, shorting works best when price already confirms bearish sentiment. So you can just combine it with technical analysis, not when you're trying to predict it, okay? Okay, what about traders who want exposures to AI without trading daily? Okay, very good question. Again, like I said, to diversify your portfolio, I don't trade daily. I have an account that I use to trade, like multiple accounts, okay, because I'm a funded trader. I have accounts that I use to trade, but I definitely do not trade daily. Okay. Yeah, you need to diversify. If you want some kind of exposure in AI, but not the whole exposure, just diversify. Just have a little bit of your portfolio into AI. How do you personally prepare before big tech related news? Okay, again, I don't. Um, Okay, when you say about news, I would say I do prepare, whereas I don't trade when there is big tech related news. Okay, I will just stay out of markets. Okay, that's my own personal opinion because again, I don't trade AI. I don't trade tech that much. I don't trade as in I don't trade like CFDs. Okay, I'm not in and out of the market on a daily basis. Okay, for tech, I do buy and hold individual stocks for long term. Okay, that's all I have for you guys. Thanks for joining my webinar. I will see you guys next week. I'm not sure what I'm gonna cover for you guys next week, but it's going to be another um economic based topic. Okay, again, just a reminder, I no longer do technical analysis for you guys. I do a lot of geopolitical, a lot of like fundamental, a lot of like macroeconomic, microeconomic. So next week we will have another interesting topic. Join if you guys are free and you guys are interested. If not, I will see you guys again. Thank you for your time. Thank you so much thank you for your time. I really appreciate when you guys join my webinars. Okay, I'm so sorry for the thousand of people that didn't get to join today. Just a reminder, we do stream on two places. We stream on Zoom, which you guys are on, and the other place that we stream on is on Vantage app. So all you have to do is actually download the Vantage app. Let me show you guys. You download the Vantage app, and then you go under Discovery or Discover, and you go into Webinars. Okay, you go into webinars and then you can just watch the webinar from the Vantage app as well. If you guys don't want to watch it from Zoom, there's usually about 1,000 people joining in from the Vantage app. So if you guys ask me a question on the Vantage app, I definitely will not be able to answer you. Can one of the hosts send me link to this? Okay, hey, Doob, you need to email Vantage to get the link. I'm not sure. Yeah, because you came in late, so you missed it. I am actually from Everest Fortune Group. Okay, so I'm actually from a research firm. Vantage hired us as a third party to do these educational webinars for you. So I actually have no control over the back end of Vantage, right? So I don't have the recording for these webinars. You need to email Vantage directly to get the webinars. My job is only to come on to here to do this educational 1 hour webinars for you guys, and then like once a week. Okay, so that's all I have for you guys. Take care. I will see you guys in a week. Bye.